Hi, I've got some Euro analysis for you today, but before I jump into that, final reminder, I'm launching Buy Low, Sell High tomorrow. This is the course that I wish I had when I was in my 20s and 30s. This information, if I knew back then what I know now, it would have changed my life. So I'm going to give you my 15 years experience in market analysis and my 9 years experience with a Chartered Market Technician designation, condensed into 9 short lessons. I'm going to teach you how to buy when prices are low and sell when prices are high. This course is not going to teach you how to day trade in cryptocurrencies. I like one of Warren Buffett's famous quotes: only invest in something that you are prepared to hold for at least 5 years. This course is going to teach you how to identify an opportunity and hold that investment for at least 5 years, possibly longer, to achieve long-term wealth. This is like a retirement option. So that's what the course is all about, and it launches at 9 a.m. tomorrow. So I'm actually genuinely super excited about that. I hope you guys are too. I think it's just a really good little collection of really good information, some important concepts there. So let's get into Euro analysis. On the 8th of March 2023, this is a full analysis with text, video and charts. This is exactly the format that I do my analysis for my membership at Pure Elliott Wave in, and I'm going to have a new analyst doing the Euro 5 days a week coming up pretty soon. He's nearly ready. I'm expecting the Euro to continue a little bit lower to a new low, to a short-term zone at 1.01948 to 1.01709, so just about an 84, 87 pip target zone. When that pullback is over, I expect upward movement to continue with an increase in momentum. This first analysis, I'm going to step right back and look at the quarterly chart for Euro. This is the low in 1985, this is the high in 2008. From this low to this high, and this is where I start my Elliott wave analysis in 1985, this upward movement just absolutely will not subdivide as a 5-wave motive structure, but it will subdivide as a corrective structure. What that means is really important. If this upward movement is a corrective structure, it's a counter trend movement, and the larger, even bigger trend for Euro would then be down. It also means, in terms of Elliott wave, the picture is very complicated, so I have 3 quarterly charts for you. If this is a zigzag and this is a double zigzag, then we have to consider how does this fit into the various Elliott wave structures. It could be part of a triangle, and it's my judgment in Elliott wave terms that this is the most likely wave count for Euro at this time. It would be a regular contracting triangle. Elliott wave triangles are always continuation patterns, unlike classic triangle patterns, which can be continuation or reversal. The angle of entry for the triangle is down, and so the angle of exit when the triangle is complete, and probably over a decade, would be down. For the Euro, the triangle has wave A and B complete. Wave A subdivides as a single zigzag, wave B subdivides as a double zigzag. Because there's already a double zigzag within the triangle, only one of the 5 subwaves of a triangle may subdivide as a multiple. That means waves C, D and E should all be simple zigzags. Wave C of a regular contracting triangle or barrier triangle may not move beyond the end of A above 1.60380. It could also be an expanding triangle. If we get a new high above that point, I would consider that, but in my experience they're pretty rare. They're not nearly as common as contracting or barrier triangles, so I'm going to go with highest probability based upon more common Elliott wave structures. After I go through monthly, weekly, daily and even hourly charts, I'm going to come back to the quarterly chart and show you 2 alternates. But for now, let's follow through this most likely wave count, and let's look at this wave in a little bit more detail on the monthly chart. The high up here in 2008 is this point up here. Now you can see the structure of this double zigzag really clearly, and if we accept that this structure here is a running triangle, then that means that we can't continue lower as an impulse, because you can't see a second wave correction as an impulse, and this would be a second wave position for an unfolding impulse. So what that means is from this high to this low, the Elliott wave structure is most likely complete, and it subdivides perfectly as a double zigzag. The first zigzag in the double is labelled cycle wave W. The double is joined by a 3 in the opposite direction labelled X, which unfolds as an expanded flat, and the second zigzag in the double labelled cycle Y is complete. I'm sorry, please ignore this notation here. I need to delete that. That is not right. B is only about just over a 62% correction of A. It is not 90% the length of A. That notation belongs on another chart. That's my error. If B is over here as a double zigzag within the triangle, then C should continue higher as a zigzag and may not move beyond the end of A above 1.06380. Within C, cycle wave B may not move beyond the start of cycle A below 0.95364. Let's take a look at the weekly chart now. We're going to zoom in on this structure, primary C of cycle Y of supercycle B, and the start of supercycle C from this V bottom, this low down here, this point down here. So now we can see the impulsive structure of primary wave C. It has a pretty good fit. All the subdivisions I've checked down to the hourly chart, it all fits. From this low to this high, this upward movement has a really good look on the weekly chart as a 5-wave impulse, and there's a nice shooting star candlestick here, very bearish upper wick, and good follow through in the following week. It looks like this upward movement for now is over, and a multi-week correction to relieve extreme conditions is underway. For intermediate wave 2, a reasonable expectation for support for intermediate 2 would be the 0.618 Fibonacci ratio of intermediate 1 at 1.01079. Intermediate 2 may not move beyond the start of 1 below 0.95364. Let's zoom in on the daily chart. We'll look at the structure of intermediate 1 and the start of intermediate 2. So this slow down here is this slow down here. Here you can see the structure of intermediate 1. It has a pretty good a pretty good fit, and I've checked it all again at the hourly chart level. From this high to this low, this is really difficult, and I did this in a video as I videoed how I worked out the subdivisions here the other day for you in my last Euro video. This downward movement subdivides okay as a zigzag. I don't think intermediate 2 is over here. It's too shallow. It wouldn't have even reached the 0.382 Fibonacci ratio, and it's too brief. So this is most likely the first zigzag in a double zigzag for intermediate 2. Double zigzags are actually pretty common Elliott wave structures. I've drawn a best fit channel around it from the start of the downward movement to the end of this bounce here with a parallel copy on the last low. And if this wave count is correct, the upper edge should provide resistance, the lower edge may provide support as minor Y of intermediate 2 continues lower. On this chart I've widened the target to a zone. We've got the 0.618 Fibonacci ratio at 1.01079 and fairly close to that. 1.01948 is where minor Y would reach equality in length with minor W, so a small target zone to work with. Minor wave X looks likely to be over here, and this is a huge bearish engulfing candlestick pattern suggesting the bounce is over. It could continue higher though, and unfortunately there is no upper invalidation point for X waves. It could continue higher as an X wave within a double combination. Intermediate 2 could just continue sideways. That's a problem with Elliott wave corrective structures. There are multiple structures that intermediate 2 could be. It could be any structure except a triangle. You have to be open-minded and flexible when corrective structures are unfolding. That's really no different to understanding how market behaves from a technical analysis perspective when it's consolidating. Consolidations are time-consuming, choppy and overlapping, or you could have sharp pullbacks and you never know which scenario is going to unfold until it's started, probably halfway or maybe even finished. Intermediate 2 may not move beyond the start of 1 below 0.95364. Elliott wave just gives those pullbacks and consolidations and bounces and consolidations, gives them structure with rules and guidelines. On the hourly chart, we're zooming in on the structure now of minor wave Y. It may unfold as a zigzag, most likely, which means minute A should be a 5-wave structure. Looks like a pretty good impulse so far. I have a short-term target for you at 1.04719. Minuet wave 5 would reach 0.618, the length of minuet 3. Were minuet 5 to reach the most common ratio, only equality in length with minuet 1, it would be enormously truncated. Well, it would be truncated. And so I'll use the next likely ratio, 0.618, the length of 3. I'll expect 5 and 3 to be quite a bit longer than 1. And the lower target is the same on the daily chart. Minute B within minor Y may not move beyond the start of A above 1.06575. Stepping right back again, remember at the start of the video when I looked at that first quarterly chart, I said we've got two alternates. We have to consider different scenarios if a corrective structure is unfolding. The first scenario considered a triangle. The second scenario considers a flat correction. Flat corrections are labelled A, B, C, and they subdivide 3, 3, 5. There is a minimum requirement for a B wave within a flat. It must reach at least 90% the length of A. That requirement would be met at 0.66627. So this idea requires more downward movement. Now if supercycle B is over at this low here as a double zigzag, then the only way it can continue lower now is as a triple zigzag. While triple zigzags aren't rare, they're really not that common either. I can see one here because I just cannot see this upward movement as any other structure apart from a triple zigzag. So I've seen a few over the years, but not nearly as many as triangles, flats, combinations. So they're really not very common. And so this lower probability of this Elliott wave structure is what makes this Elliott wave count a lower probability wave count. I hope that makes sense. This whole Elliott wave and technical analysis is all an exercise in probability. So what that means is it's less likely price is going to continue lower to make new lows below the end of cycle wave Y here, because then it would be a triple zigzag. That's not a very common structure. If this wave count does unfold there, low probability doesn't mean no probability. If the minimum is met, if a triple zigzag does move lower, then supercycle B could even move beyond the start of A, as in an expanded flat. And when it's over, supercycle C would then be expected to move beyond the end of A to avoid a truncation. And finally, another idea. Now for all of my quarterly charts from this low to this high, I'm labelling it all as a zigzag, and this high to this low, it's all labelled as a double zigzag, although the last one, a complete double but extending lower, possibly as a triple. So all the subdivisions are the same, but when we put those subdivisions into a bigger context and consider how they would fit into any Elliott wave corrective structure, then we must also consider a huge double combination may be unfolding. Now double combinations are actually pretty common structures, and they are almost always comprised of one zigzag, and here we have a zigzag, and then one flat correction. We could have a flat correction, but the reason why I am judging this to have a low probability, lower than the triangle idea, is the structure of supercycle wave X. One of the Elliott wave rules is the maximum number of corrective structures in a multiple is 3. That count of 3 applies to W, Y, and if there is one, Z. So W, Y, and Z themselves may only subdivide as simple corrective structures. You may not label a W, Y, or Z wave with W, X, Y, X, Z within them, because doing so multiplies the number of corrections within the multiple beyond 3 and violates the Elliott wave rule. This is one of the most commonly misunderstood or simply ignored Elliott wave rules, and if you learn nothing else but this from me, if you see work that labels its Elliott wave structures like that, move on. It has no predictive value because it's not following Elliott wave rules. And so you can label W, Y, and Z as simple corrective structures, but the count only applies to those three. It doesn't apply to the X waves which join those structures in a multiple. And so technically X waves can be any Elliott wave corrective structure, including a multiple, and the rule is not violated. However, in my experience over now 15 years of doing Elliott wave analysis, I have seen it happen, but it's really uncommon. It's almost always X-wave subdividers, simple corrective structures, most commonly a zigzag, sometimes a flat, rarely a triangle, and extremely rarely a multiple. It can happen, but it's really uncommon. So again, the lack of the low probability is judged upon how common the Elliott wave structure or subdivisions are, and this has a low probability. I hope that makes sense. Well, this is a really confusing chart, and I think interpreting what's happening here with all this choppy overlapping movement really does take quite a bit of knowledge of how Elliott wave corrective structures unfold, and so those are the 3 wave counts I can see at this time frame. This one expects upward movement. X would be over here, extremely likely to be over. It's extremely unlikely to continue lower, as a triple zigzag could do it, but really unlikely. This one expects most likely a flat correction now to unfold for Y, A, B, C, so A to take several years to unfold as a zigzag, most likely, or could be a flat, can't be a triangle though. Because stock charts don't have volume data, I'm going to do my volume analysis for a motive wave, and then I'll do the rest of my technical analysis on stock charts. So looking at volume, this is a major low. There was strong movement for this first green candlestick. It's actually a lower low and lower high, but we're probably seeing mostly upward movement. The candlestick is green, and it looks like there was push from volume off the low. Volume is declining as price moves higher, pretty obviously, and continues to decline now as price moves lower. So there's weakness now up off that low. On balance, volume is constrained. I'd watch for a signal here on the weekly chart. Money flow is neutral. It exhibited double bullish divergence at this low between price on a closing basis and money flow did just reach oversold on the weekly chart. And so that supports the view that this low may be sustained. On the daily chart, at this last high here, there's a dark cloud cover with push from volume. So that's a fairly bearish candlestick when it has push from volume, and now it's unsurprising we're seeing downward movement. This could be resolved now, or we could see price fall further, and I've identified support. We'll look more at support and resistance on my stock charts. At the low here, there was a bullish engulfing candlestick pattern. Actually, these 3 together also make up a morning doji star, but a bullish engulfing pattern is actually a stronger reversal pattern than a star. So I'm just going to note the bullish engulfing pattern, and it has pushed from volume, so that's really good to see. It occurred after after money flow reached oversold and exhibited double bullish divergence. Did not reach oversold, but did exhibit double bullish divergence. And on the weekly chart, it reached oversold and did also exhibit bullish divergence here. At the high here, a little bit of bearish divergence, not nearly as strong as this previous bullish. It's only single, and not that. It's only single, and it's not repeated, and so it's not necessarily indicating a huge trend change, could be resolved now by this downward movement. The rest of the indicators for euro on the weekly chart, shooting star candlestick here on the weekly chart. This is a bearish reversal pattern, and now price has fallen through a little cluster of support, which is now offering resistance, and support below is pretty thin. When I identify support and resistance, I look back left on the chart and I put these horizontal lines across as many highs or lows on weekly chart, opens and closes on daily charts, as many as I can, and try and find lines that are tested multiple times with support and resistance previously. You'll expect it to see it again, and so that's fairly thin here. So now price is closing below this previous support. It could fall with a bit of power actually towards support at 0.970. ADX is declining. There's no clear trend. The previous downward trend reached very extreme. RSI reached oversold. Money flow also on the weekly chart exhibiting bullish divergence at the low, and a bullish long lower wick on the weekly chart. Given the extreme conditions with RSI oversold and divergence and ADX extreme, that supports the view that this low could be sustained. RSI is now neutral. ADX is declining, there's no clear trend. Stochastics reached overbought, price reached resistance, expected downward swing until stochastics reaches oversold and price reaches support. That's the model I use for a consolidation or non-trending market. ATR declining along with volume as price moved higher and low. There's some weakness in here, an upward and downward movement. It could just be that it's weak for the early stage of a new trend though. It's not really clear because it is weak up and down, so weakness continues in both directions. On the daily chart, there's dark cloud cover at the last high. RSI ADX told us the upward trend reached very extreme, and RSI just reached overbought. There might actually be a little bit of tiny bearish divergence here, but it's certainly at the weekly chart level. That's a bit clearer. So unsurprising, we're getting some downward movement. Support about 1.065 has been breached. There's a strong bearish engulfing candlestick pattern. Expect price to continue to fall. Might find a bit of support at the 200-day moving average. ADX declining at both time frames, there's no clear trend. RSI, stochastics neutral, ATR declining as price falls. There is weakness in both volume and range in this downward movement. The moving average situation overall bullish with a golden cross back here. The short and the mid are above the long and price is above the long. The long and the mid are positively sloped. Overall, that's a bullish look. That's it from me with your Euro analysis, and I'll be doing this more regularly and coming to you 5 times a week when my new analyst is ready for you. Thank you so much for your support.